So people often ask me of late if I think Facebook is overvalued or undervalued. So I began by doing my traditional analysis, and the results actually surprised even myself. So, is Facebook stock a buy? That's the big question people are asking right now. And some interesting headlines to take into account. One of them, Facebook breaks out with shops, which is a big success. And interestingly enough, there are only 3 mentions of e-commerce in the latest 10K. Yet the stock has been trading below expectation in the last probably 6 months. That is probably a knee-jerk reaction to the poor media coverage. What still remains true is that there are almost 2.8 billion people globally using Facebook. 240 million are expected to use it by 2025 in the United States. That's almost 70% of the US population. And 80% users are only using mobile. Here's an interesting quote. "This was a strong quarter for our business, as the acceleration of online commerce we've seen during the pandemic continued into the holiday season." And that is the Chief Operating Officer, Sheryl Sandberg. And Facebook have also announced a new ad product called Dynamic Ads for Streaming. So a lot of innovation happening on multiple fronts. Let's dive in to my valuation, which uses the cash grows, risk matures model. What I'm going to do is do an analysis of the Facebook strategy and the strategic moves that they have available to them, and put that into a valuation model where we can let the science talk to what the real value of Facebook should be. So let's begin our analysis. And the first thing to note is that Facebook has an operating loss that they're still carrying forward and will spread over the next probably decade of $12.8 billion. Revenues are running currently at $85.9 billion, which is essentially the current revenue. Operating margins are sitting at 47.2%, which gives you an operating income, which we call EBIT, of $40 billion. Let's take a look now at the graphs which give us a perspective of the history of Facebook and how they've performed. And I went back to 2016 and then looked at what the street was saying all the way through, as much as I could gather, into 2030 time frame. And so the first thing to look at is that revenue growth was sort of growing in the range of 55,000 in 2016, and has been declining all the way down into the 25% region. Forecasts are continuation of the decline in revenue growth, going down to the 20s and then even to the 16s into the foreseeable future. So I'm thinking that over the next 10-year projection, the average growth rate will be sitting around the 13% level. Operating margins in 2016 were as high as 60%. Those two have been dropping, and those have dropped down into the 40s, 38% range, and the street is forecasting that they will be sitting around the 36% range, maybe incrementally crawling up to 42%, but that seems to be the perspective of what the future holds. And so my analysis averaged the future margins sitting around 38%. So that is essentially how I came up with the forecast into the first part of the analysis, which is the cash flows. The second part of this really looks at what the growth potential is. And in order to do that, we need to dive a little bit into the strategic storyline or gameplays that are ahead of Facebook. For the Wardley map, which we use to analyze the various strategic options in front of Facebook, we examined the latest 10K and earnings calls, and from that abstracted the components that make up the Facebook value chain. We then positioned these into 4 areas: Genesis, Custom, Product, and Commodity, according to the levels of maturity of the component and its related chain. From this, we were able to discern 4 anchors, which are the core stakeholders, namely developers, sellers or merchants, marketers, and users. Let's begin looking at the end user, which is in the product and commodity spaces right now. The rightmost chain is really about the external influences on the user experience, from government to mobile and browser dependencies. These are all mature commodity and standard components. At the very bottom, I linked the operational elements from engineering, design, marketing to this chain, since they essentially prop up the whole user dimension. You can also see that these operational components cost as a percentage of revenue. These operational teams all prop up the other chains, so I drew them underneath. Here you also see how media and publicity is driving the chain to the commodity as Facebook continues to receive more negative sentiment. The second user band depicts the traditional Facebook communities and connections, also highlighting some of the more challenging components like data protection, publicity, duplicate accounts, and data privacy and metrics, all driving the day-to-day user engagement across the platform. The third band describes the marketer, who is the buyer or consumer of advertising on the platform. All the components needed to drive advertising campaigns, including things like budgets, placement, and analytics. You can see how the quality of advertising is evolving towards a commodity as it becomes more difficult to design effective ROI, return on investment, campaigns. The seller band is the most interesting right now. This is the merchant capability for social commerce and only began to be seen about a year ago. The components for this are still fairly immature and in custom development. Things like live streaming of social shopping events. Also the development of technology for native checkout on messaging applications. So in summary, when you look at the analysis, I've come up with 3 different gameplays which I then fed in to my valuation model. The first is the two-sided markets, which is essentially building on the network effects, but really taking it into the e-commerce space. The second is tightly coupled to e-commerce, but it's really about market enablement. And what that means is enabling a very fluid checkout process so that essentially you can do things like checkout through messaging applications. We call that social commerce. And then my third gameplay, which may be a little outlandish, is the evolving education community. And it really poses the question that with COVID receding, will online education and education communities still thrive? And perhaps Facebook can take advantage of that. So building into this growth proposition, the first thing I did is an analysis of what the reinvestment needs to be over the next decade. And I came up looking at historical performance with what we call a sales to capital ratio of 1.5, which essentially means that for each dollar in investment capital, we'll be able to generate $1.50 in sales. And essentially, what this reinvestment is made up of is depreciation, capital expenditures, any expenditures on acquisitions, and then a change in non-cash working capital. Now, when we look at the growth projections, I have essentially looked at a revenue growth next year, and then I've projected what the growth in revenue will be from years 2 to 5 onwards. And then what I'll do is in year 6, I will decrease growth down all the way to year 10 or 11 to the risk-free rate. So next year, I'm calling for growth at about 25.4%. And in years 2 to 5, I'm going to level growth at 16% and then decrease it all the way down to the risk-free rate in the terminal years. From an operating margin perspective, I looked at the pre-tax operating margin in year 1, and essentially I think that'll be around the 40% level. And then in year 5, we expect those margins to be around 46%, and we'll level it out at 46% into the foreseeable future. So we'll grow margins from 40 to 46% over the next 5 years. So let's talk a little bit about the terminal year. And here I am expecting that revenue growth will settle on the current risk-free rate, which is, for the purposes of this analysis, running at about 1.7%. I'm expecting that the operating margin in year 5 onwards will be sitting at around 46%. I then did some projections in the terminal year for the stable return on invested capital, which is essentially the after-tax operating income divided by invested capital. And I'm tying this to the terminal cost of capital, which we'll come to a little bit later on, but essentially that is going to be, in my projections, around 7.2%. From this, we're able to derive the reinvestment rate in that stable period, which is effectively the growth rate divided by the return on investment capital, and that calculates out to about a 24% range. And so from that, the terminal value is essentially calculated, which is the free cash flow to the firm divided by growth minus the risk rate. And we get to a value of about 1.3 billion in the terminal years. So let's take a look now at our cash flow forecast given these inputs. I begin the forecast and revenue is going to be growing at about 22%, and next year and then the following year up to 25%. We level out at 16%, and then essentially we're going to drop in year 6 from 13% all the way down to the terminal risk-free rate, which is equal to our growth rate of 1.7%. What that really translates to is next year revenues of about 85 billion, growing to 107, 108 billion, and then over the foregoing period and into the terminal year, it will probably be projecting at around 280 million. If you look at the operating margins, next year was going to be close to 47%, and then essentially it'll drop to 40% and slowly but surely grow up again to a 46% level, and I'm calling for it to be at a stable 46% level for the outgoing years. That gives you a operating income of about $40 billion next year, $43 billion the following year, and then growing outward from there into a terminal year, which is essentially in the 128 million range. For the tax purposes, their current effective tax rate is 12.16%, and effectively I carry that through for the next 5 years, and then I grow it up to the marginal tax rate, which is around 25%. But for this analysis, I've stuck to 27%, given that we're hearing that marginal tax rate may increase over the next period. And that leaves me with a operating income after tax next year of $35 billion, the following year of almost $40 billion, and flowing through into the year 10 of $93 billion. I then used my sales to capital ratio that we looked at a little earlier on to derive my reinvestment. And reinvestment is running at about $10 billion right now. And I grow that into the $14-15 billion region over the next 5 years, and then drop it down again to the almost $3 billion level as we level out into years 10. This then gives me a free cash flow to the firm next year of $25 billion, the following year $24 billion, and growing that out into the year 10 of about $10.3 billion. And so we then take this free cash flow to the firm and discount that back at the cost of capital, which we'll discuss the calculation for that shortly. But essentially, next year I'm forecasting that as about 6.11%, and then growing all the way into the terminal years, I think it'll go up to about 7.18% as the business morphs into what I think will be a slightly different looking business with a different risk profile, and also I think they may take on more debt than the very low or insignificant debt that they have right now. We then have a return on invested capital next year, which is sitting at about 33%. I think this will hover around that region, maybe in the mid-years, up to the 40s, early 43%. And then into year 10, I think it'll level out at about 40%. Now, if we look then at the terminal year piece of the model, as we've mentioned, we are going to essentially flatten growth for the terminal years and grow this at the risk-free rate, which is at 1.71% right now. That'll mean revenues of about $283 billion. Our operating margin will be sitting at about 46% in the terminal year, giving you a operating income of about $130 billion. The marginal tax rate I'm forecasting will be a little bit more conservative than it is right now at 27%, giving you an after-tax operating income of about $95 million. And then we calculated reinvestment, taking the terminal growth rate, the risk-free rate, dividing it by the terminal return on capital, and gives us a reinvestment rate of about $22 billion, giving us free cash flow in the terminal year of $72 billion. I'm going to discount that at a 7.2% terminal cost of capital, and we'll discuss that a little bit later on. Remember that we said the terminal return on invested capital will be equal to this cost of capital. Now let's take a look at the risk side of the equation. We're getting to a calculation of the cost of capital. Let me show you how I broke down those numbers. Cost of capital is the weighted average of the cost of debt and the cost of equity, multiplied by the debt ratio. Essentially, we're going to build this on the current United States risk-free rate, which is sitting around the 1.71% when I did this analysis, and that's really the 10-year default risk premium. So let's look at the cost of equity calculation. The cost of equity is made up of the risk-free rate plus the beta times the equity risk premium. And the equity risk premium, we're going to take into consideration also the country risk premium. So if we look at the beta calculation, which is essentially the businesses that Facebook does business in, and obviously they're probably 100% advertising now, but could well be evolving into more of a commerce play over the next decade. And so what we've essentially done is taken a ratio of enterprise value divided by sales to calculate what percentage of the business they are in currently and will be in the future. So currently you can see that the advertising business has a bottom-up beta of 0.7711%. Now I think they'll move more into an information services type business, which has a different bottom-up beta. It is 0.9739%. And we'll take both of these bottom-up betas and we'll labor them up, the betas that we use currently next year and then in the upcoming at the end of the 10-year. If we take that unlabored beta of 0.7711 and we labor it up, we get to a number of 0.7790. Now, for the weighted equity risk premium, essentially we look at the regions that Facebook does business in, and they really only disclose very broad pieces of geography from Asia Pacific to Canada to Europe. And what we'll do is we'll take revenues and we'll use them to give us a weighted equity risk premium. We'll really gather the equity risk premiums in these different regions using the gross domestic product and the different country risks to group these all together. As an example, the Asia Pacific, they do $19 billion of revenue there. The the risk premium for the Asia Pacific is sitting at about 5.49%. 23% of Facebook's business is in this region, and that gives us a weighted contribution to the equity risk premium of 1.27%. You can follow the same logic through for Canada, which is gives us a weighting of 0.11%. Europe is 1.32%. The rest of the world is 0.68%. And then there's the general global, which is everything else, sitting at about 2.35%. When you add all of that together, you get a equity risk premium for all the regions that Facebook does business in of 5.73%. So as a reminder, when we do a levered up beta, what we're doing is taking into account the after-tax benefits of debt. And so we multiply that by 1 minus 27%, the marginal tax rate. And then we look at the current debt to equity, so 0.7711, and we multiply that by the current debt to equity. That gives us the levered beta for the first year. And when we look again at the year 10, you remember that from information services we had an unlevered bottom-up beta of 0.97739. We do the same thing, take into account the tax benefits, but the debt to equity ratio is now 10%. We will get a levered up beta, and really those numbers come out to 0.7790 for year 1 and 1.045 for year 10. So those will factor in to our cost of equity calculation, together with the equity risk premiums, which were sitting around 5.73%. If we then look at the cost of debt calculation, we have no default spread for the United States, so that is 0. The credit rating for Facebook is a AAA, which has then a default risk of about 0.69%. We think that may grow to 1% in year 10 and into the terminal years. So we'll take that credit are spread into account as we do our projections. So then we have the debt statistics, which essentially use a debt equity ratio of a very small 1.4% right now, growing it up to 10% in the future. And so we add those numbers together, we get a cost of debt of about 2.4%. Remember, cost of debt is calculated by taking the risk-free rate, any country default spread added to that, and then any of the company default spread added to that, which from year one gives us an after-tax cost of debt of around 1.75%. In year 10, the cost of debt we're projecting will be the risk-free rate again of 1.71%, 0% country default risk, and we think a 1% company risk-free rate, giving you a total of 2.71%. In turn, that'll give you an after-tax cost of debt of about 1.978%. When you plug these numbers in, we're going to get to a cost of capital of 6.12% in the following year, and for the terminal years, 7.178%. So what does all this mean, and where does it all translate to? A value of operating assets of $1,131 billion. We subtract from that $11 billion of debt. We add on the cash balance of $62 billion. We didn't factor in any cross holdings or minority interest, and that gives us a value of equity of $1,182 billion. The value of options is zero because they're issuing restricted stock units, and so I took that into account in my share count. And so the number of shares outstanding is about 2,092 million. That gives us an estimated value per share of $474. When I did this valuation, Facebook was trading at about $306, and so that's a price difference of 55%, which is really quite interesting. If we turn our attention now to the graph, you'll notice that if we put over the $474 that we think we can attain and the $306 where we are currently, you can see that Facebook has traded in this range since October of about 250 to 290, and really over the past 10 years we haven't yet broken out of this 300 range, but you can see that it's just currently done that. So I think that over the next probably 6 months, we could see Facebook reaching these levels of maybe the early $400 to the mid $400. So in the early 2017 and 2019, Facebook was trading as low as $150. Just before we entered COVID, it was trading at about $220 and then took a drop to about $160. Since then, it's climbed as high as $290, but really has been sitting in a band around $250 to $290 since October. Just recently, just as I was doing this valuation, it breached the 300 mark and has been moving up. As we show on this graph, I think it's got some potential to move up quite substantially. I think this valuation has been reasonably pessimistic, hasn't been too over-optimistic, and I think that the 400s are definitely attainable. The question becomes when, and the second question becomes how much does the general noise through media and the other things that Facebook attracts, how much will that impact the actual pricing story of the equation? But right now, $306 compared to my prediction of $474 is about 64% difference. So that's quite a big margin of error to take into account. Well, thank you for watching this video, and I hope you enjoyed it, and I hope you followed along with me as I described what I think the value of Facebook is and how the strategic game plays, where I came up with 3, feed into this valuation and give you an idea of what the future is. Obviously, none of us have a crystal ball, and it's impossible to forecast accurately what events will occur. All you can do is you can take a view now that says this is the value that view is projecting, and compare that to where the current pricing is, and hopefully it's a optimistic view for Facebook. I think that if Facebook can pull off this move from advertising to commerce, and in particular social commerce, I think there's something to be had there. I think the advertising plays will still continue to follow them along, and they'll become much more Amazon-like. But the big thing that they'll add to what Amazon does is essentially the social interaction in commerce. After all, when you go out shopping to the mall or to a store, it's very much about that social interaction. Current e-commerce is not very social at all. It's a one-sided interaction. And so I think there's something very interesting around the virtual reality that Facebook are very heavily involved in, and the social commerce play. Thank you for watching.